All right, Bob, you were just saying that you think because of the stimulus that has been planned that perhaps the gross domestic product will not fall quite as much in the year 2011?
Yes. I think that stimulus could bring the GDP minus down to even during the second and third quarters of next year. The only thing is that I now understand that our president is planning to expedite that plan by moving some of the, quote, action into this year, because he said that he's going to create 600,000 jobs and that he's already created 160,000. And we know that is untrue. Our president, like most everybody in Wall Street and in banking, in insurance, corporate America, and in Washington, lies. And so it's the same as the unemployment figures which you explain. A different way of explaining is that U6, which is government produced, is 16.4% unemployment. U6 includes a thing called the birth-death ratio, which allows government to create as many jobs as they see fit in small and medium-sized business that don't exist. In other words, it's a method of fudging the figures. And if you take and do away with the birth-death ratio, and you go back to the 1980 formula of figuring the numbers out, you'll find that unemployment is 20.2% now. And U6 contains short-term unemployment, those who don't get any checks anymore from the state for being unemployed, and the part-time workers, and those who are discouraged. And if you put that all together, you find that it's really a true reflection of what is really going on. And so I think that the president can come up with any figures that he wants to. Any figures that he wants to. And so it will be the way he wants it to be.
Hold that thought. We'll be right back in a moment, Bob. Well, this is Dr. Stan, and Bob was just talking about the unemployment figures. They tell us it's 9.4%, but then there is something called the U6, and the U6 is the unemployment, and this is the people who are either aren't getting the unemployment checks any longer. In other words, they've run out of their unemployment benefits. They have given up. They've been unemployed for so long. They've had to take jobs that are basically pay far less than it did before. They're only working part-time. And then they have something called the birth-death ratio, which allows them to fudge the figures. And there's an old adage that says that figures don't lie, but liars can figure, and they all work for the government. And so they're coming up with figures to make you feel better. The official government figures for U2 now is 16.2%, but according to Bob, it's really about 20-something, about what, 20.6%, 20.2%?
20.2%.
All right, fine. So you picked a story up there. So basically,
and they continue to do the same thing with the CPI figures, which are the inflation figures, and they're calling it somewhere around 2-3% or something like that. When in fact, the figure is still around 9% because of the increase in food prices, and now we're getting increases in the production of petroleum products, and they have gotten a break here recently from the diminution. There's been a slight retrenchment in rents, which make up 31% of the CPI. In other words, what can you rent your house for, if you can believe that? And so those figures are all skewed. I think if you look at the monetization, the loans, the commitments, and you look at the increase in money supply, you'll find that it has to be somewhere in the 9 to 10% area. The M3, which is no longer published, hasn't been for over 3 years now, is running around 18%. Well, if you get an 18% in the old M3 figure, you've got to have something at least in the 9 to 10% area inflation. You've got monetization, which is highly inflationary. The U.S. government, before the end of September, along with the Fed, will be creating new money and credit out of thin air of approximately $2.2 trillion. Now, that's going to go directly into the economy, and it's going to cause inflation. And then you have all of the loans and grants and flow-throughs that have been created out of TARP and these other programs that they've got. And all the commitments add up to about $14.8 trillion. And so who's going to stand there and tell me that there's not going to be any inflation? Who's going to stand there and tell me the stock market and the bond market can stand up under that? Of course they can't. Interest rates have already started to move higher, and it's only a matter of time before the market goes back down and tests its bottom. And every time gold and silver stick their heads up, then the government comes in and tries to bash them, with the assistance, of course, of the commercials on the COMEX. And so I think gold and silver are going to triumph in a big way as a result of what's going on over the next 2 to 3 years due to hyperinflation. And there's no way they can avoid it. And that's why foreigners are not buying as much dollar-denominated investments, because they don't want to have the dollar. They're selling it. And that's why the dollar's coming down from 89.5 on the USDX. It's around 80 right now. And it'll go to 71.18 and test it. And sometime, over the next year, it'll break it. And eventually, I think it'll go to 40. And that's if we're lucky. It's just like the Dow going to 4,000, if we're lucky.
Well, I think it's really very important for our listeners to understand the bond market. Now, the bond market's about 10 times larger than the stock market. We always talk about the stock market, but the bonds are what are bought by sophisticated investors, treasury bills, treasury bonds, but the corporate bonds. And, of course, these are directly related to the interest rates. And, of course, when the interest rates go up, the price of the bonds falls. And, of course, because they're really desperate to try to get people to buy our treasury bonds, because people are not going to buy the bonds, especially foreigners, when they see the value of the dollar falling. Why invest in a bond denominated in dollars when you're going to get paid back in dollars that are of less value? So aren't the bond prices, bond interest rates really going up? And doesn't this really threaten the stability of the bond market?
It certainly does. And I've got a projection now within 3 years, and probably more like 2 years, the 10-year Treasury note, which closed today at 3.85%, which we said when it was 2.35 at the beginning of the year would go to 3.50, which it did a couple of weeks ago. I expected it to take longer, but it hasn't. It's gone more quickly. And I expect that because of what's going on worldwide in this crowding out process where governments are desperately trying to raise money, it's going to continue because they're all having revenue shortfalls to offset, their fiscal costs. And so what's going to happen is that interest rates are going higher, and I see the 10-year Treasury note at 7.75% to 8%. And I made this kind of prediction in 1991 and in 1991 and 92 and 3. That rate moved up, and the 30-year was 8 3/16, which was exactly what I had predicted, which really was incredible. It even surprised me. And so if you translate that over to the 10-year T-note, then you should have around 7.75% to 8%. And so that's where I think it's headed. That means that the real estate, both residential and commercial, are going lower. I saw Gary Schilling come out with an estimate today, and he's talking about another larger depreciation in value of residential. He's talking, I had called a median loss